So, ladies and gentlemen, traders and investors worldwide, welcome back to another episode of the Market Talk series. As we gather here once a month to dive into the intricacies of trading and investing, I'm pleased to introduce you to the one and only Daniel Lacalle. Now, Daniel holds a PhD in economics. He is a senior economist and lecturer for IE Business School. Currently, he is the chief economist at Tresis. Daniel is the author also of the best-selling books, The Life in the Financial Markets, The Energy World is Flat, and Escape from the Central Bank Trap. We will tap into Daniel's insights and strategies in this Market Talk episode. So, Daniel, welcome to the Market Talk episode.
Thank you very much. Thank you very much for having me. It's a great pleasure.
It's an absolute honor. So, a lot of experience, a lot of insights in the markets, in the economics, especially now the world is just changing drastically, shifting powers and all this stuff. So we are really excited to hear from you. How do you think things are going to move towards down the track? But let's start first, and please share with us, how did you start your career and what made you get into the field and move forward with that?
Well, I started my career in the energy industry. I started in the industry in general, focused on basically oil and gas, and also natural gas afterwards. And I was very fortunate to join in one of the major oil companies, the presidential area that was in charge also of investor relations and in charge of everything that had to do with international finance. So from international finance and commodity trading to investor relations and fixed income markets, I was very, very interested in the financial markets from all angles. And I had the opportunity, I received an offer to join an investment bank from the industry, and I took it rapidly and decided to look at it as the way in which I could go to the buy side, which ultimately was my most important interest, or at least what I really wanted to do. And quickly enough, I was actually very fortunate to receive an offer to join Citadel after a very, very, very prolonged and grueling hiring process, and that was for me the beginning of a very long and an exciting career, starting in the hedge fund world, market neutral at Citadel, which was fantastic, great place, very good friends. And then to the energy investment and energy and commodities hedge fund, Ecofin. After that, in PIMCO, where it was another fantastic opportunity. And throughout all that process, I was able to expand my experience, starting with energy and moving into not just equities, but then also commodities, but then also currencies and precious metals, and finally macro and macroeconomic analysis.
Wow. Sounds a long of
it's a lot, very old. I'm very old, yeah. So a lot of years.
Yes. So that makes you a much more experienced and expert in the commodities and in the oil industry. And recently, I was watching on your YouTube channel and where you were explaining the oil prices likely to reach $120 per barrel, right? And can you please explain us what's the thought behind this, or why do you believe we are moving towards now we are above $90, just roughly speaking. So to 120, it's a bit of pretty much $40, give or take. So what do you see?
Well, in that video and in subsequent articles that I have published, what I was basically saying is that oil prices tend to sometimes overshoot and then undershoot. And as we saw in May 22, when oil prices reached $122 a barrel, immediately demand destruction kicks in. So what I say in my video is that right now we are almost in a perfect storm for oil prices. On the one hand, central banks have stopped hiking rates, and for most of the people that are watching us, the most important factor in commodity trading is actually monetary, is actually whether there is a loose or whether there is a tight monetary policy. So if we look at what happened actually from May 22 to May 23, oil prices and most commodities collapsed in markets precisely because of rate hikes and monetary contraction. And at the same time, there was an underlying bullish fundamental trend in the supply and on the demand side. On the supply side, I think that everybody that is watching us is aware of the fact that there is a very tight level of supply. Sanctions against Russia are making the supply much tighter. OPEC is cutting production. And on the demand side, at the beginning of that decline in oil prices, the weakness of the Chinese economy was sort of helping oil prices go lower. However, the Chinese economy seems to have bottomed down. So now, since May, what we have is the perfect storm. On the one hand, the Chinese economy seems to be at least increasing in terms of imports of energy. Second, the supply tightness remains. The underinvestment in energy remains, which is a very, very significant problem. And at the same time, central banks have stopped hiking rates and reducing money supply. Therefore, those three elements drive oil prices higher. And the risk, obviously, is that if oil prices overshoot and they go back to the $120 level, which is what I mentioned, that's when demand destruction kicks in. And we would see the immediate impact, especially in developed economies.
Yeah. So what about the emerging markets? Can we associate this oil supply and with the emerging markets? Maybe they're going to see some prosperity down the track because of that, or what do you think regarding this?
Yes, it is certainly higher commodity prices in US dollars certainly helps exporting emerging economies. And I think that it's pretty obvious when we look at the Saudi Arabian or the Emirates or the Mexican market, even the Mexican peso. The Mexican peso is doing phenomenally precisely because of the higher imports from the developed economies and the increase in currency reserves that they are receiving, isn't it? So from my perspective, I think that a period of relatively elevated commodity prices certainly helps some emerging economies. Obviously, there are problems in many emerging economies because despite their exporting activity, they continue to have a very large fiscal and a very large trade deficit. So, for example, even though soja prices may go up or oil prices go up, unfortunately, that is not going to help, for example, the Argentine peso or similar. But if you look at other currencies, as sort of an idea of how it is, of how the commodity situation may be supporting some emerging economies, the Mexican peso and the Colombian peso are a clear example of that. No, it's two economies that, despite not doing phenomenally well, are seeing a larger inflow of reserves from their exports.
Yeah. Now, about trading commodities like gold, like the oil, platinum, palladium, and the rest. What are your thoughts about that? But if we can narrow it a little bit from the retail trader side, like, and then I would like to dive into the hedge fund process and make some comparison, just to make it more clear. Retail traders, like we trade based on the price speculation, and we don't, let's say, order the barrels to be delivered, or we hold the blocks of gold and the plates and all this stuff. So can you please help traders to understand some, maybe, what do you believe about that, or key differences, like what trading commodity is for a hedge fund maybe, and what trading commodities is for a retail trading activity?
It is very different, certainly. No, okay. To start with, a hedge fund is always counting with a significantly larger amount of capital, a massively larger amount of capital. But also, we need to understand that usually many of the views about commodities are relative. No, so it's not necessarily taking a bullish view on the price, but simply on a relative basis. Even hedge funds, for example, as I've worked in, may be working with the short-dated view about what is going to happen with gasoline prices from one season to another. No, so I think that is one element. From a retail trader perspective, I think that investing in commodities has to be very much a very disciplined and structured study, which has to be having very solid and undoubtable loss mitigating trades. No, stop losses are a very important factor in commodity trading, because, as I mentioned before, for a retail trader, they need to understand that even though we may have a very detailed analysis of supply and demand, the most important factor is monetary. And therefore, you have to have good stop losses and take profits, and look at quite narrow ranges in which you can actually trade in and out quite well, even in commodities that tend to do very little. You mentioned, for example, gold. Between 1650 and 2000 an ounce, you can actually generate quite significant profits with a trading that is not necessarily taking a long-term view or a supply and demand picture. If I was to take long positions on commodities, I would certainly pay attention, as I said, to the monetary environment more, actually, except if it was, for example, in the refining products or in refined products, gasoline and diesel. You would have to look at the seasonal structure, which is pretty obvious. But the monetary aspect is very important. Monetary tightening and reduction in global money supply immediately means lower commodity prices. It doesn't matter if there is a geopolitical war, if there is a big risk, etc. it's very, very difficult to fight against money, and that is the most important factor. For a retail trader, I would also suggest to try to avoid conspiracy theories. Is to be very, very disciplined about price. Forget about what you think that the Saudis are going to do with oil. Forget about what you think that the Russians are going to do with coal, or what the Argentines are going to do with soja, or the Indonesians with nickel, if you want. Pay attention to the underlying trading structures. And obviously, from a hedge fund perspective, the thing that is different is that you can take comfortable short positions to adjust the risk exposure of your long side. And in hedge fund commodity trading, there's always the option of having the let's say the weaker commodities not viewed from the perspective of always going down, but being a source of funds for the longs that we take. And that is an important element, is not looking just at directional trades, but at relative pairs in terms of the ability to generate some alpha in commodities. And commodities, we always hear in the market the comments about there's going to be a super cycle. Okay, fair enough. That's fun. But forget about super cycles. Because first, it's very unlikely to happen, those super cycles. Furthermore, commodities shift very aggressively and they're very volatile. So pay attention to the monetary aspect, tightness, loosening of monetary policy, key factors. Pay a lot of attention to short-term range trades in which you can get 25% up and down and move in a long-term sort of similar trend. And if you can go short, make sure, for example, that the most liquid, the largest elements in the commodity spectrum, coal, oil, Brent in particular, tend to be really good relative shorts, despite you can have a bullish view about coal, you can have a bullish view about oil, but you can have a much better way of creating alpha and continuing to be short, or at least hedging with the highest liquidity. Be very concerned, and finally, about very illiquid longs or illiquid shorts. This is not a market for the heavy-hearted.
Yeah, indeed. So that brings another question, but I will leave it to ask you after that. I would like to ask you, Daniel, are you involved in currency exchange trading? And if yes, how do you prefer to use them in your advantage, investment strategies particularly, or trading? So how do you see the currency exchange world?
For us, the most important currency trade that we are constantly debating about is the hedging of the currency in equity and fixed income portfolios. In the case of non-US dollar equities and fixed income, what we tend to do is that rarely we hedge it with the currency exposure entirely, maybe 20%. And then we take short-term views on the commodities that we trade with. So, for example, with the yen, very loose monetary policy added with persistent inflation, added to a challenging balance of trade, immediately means that unless the Bank of Japan can perform miracles, the yen is going to underperform relative to the US dollar. Periods of tightening, periods of weakening of fundamentals in the economy always tend to drive the dollar higher and the euro and the yen and the yuan lower, for a very simple reason. No, the US dollar is the safest asset in a risk-off environment, because I always say that the US dollar is the house with the largest number of windows and doors in the middle of a fire. So what we do is that we take short-term views on currencies, and we trade on them. We trade on those, and they're mostly on developed economy currencies. We don't, in the case, for example, of emerging markets, we never use domestic currency either in fixed income, or therefore we don't take long-term views. No, but main currencies that we trade: dollar, euro, yen, pound, Swiss franc, yuan, ruble. So, and usually with a directional perspective. And the way that I see it is, I always pay attention to who is loosening monetary policy, who is tightening monetary policy, what level of inflows into the economy are rising or falling, and that drives an increase or a decrease in reserves. And that usually creates, and we're talking about currencies, most of them, not the ruble, but the others, that trade in a very narrow range, no? So in the case of the euro dollar, when it reaches parity or slightly below parity, you have to go basically net long euro dollar. When it gets to 117, 120, certainly it's time to again, as we mentioned with commodities, within a very tight range. The long-term picture of the euro dollar is not positive.
Yeah.
But the range short term is very attractive, because again, we're talking about 16, 17, 15% trades that can certainly boost a little bit the performance of a portfolio. Our portfolios are obviously of multi assets, no? In the case of the Swiss franc and the pound, it's more about directional short-term trades relative to monetary policy. So for us, there's going to be a recurrent message in our conversation today. Monetary policy is everything.
Yes.
Monetary, and I find it sometimes surprising when I hear some colleagues say, I don't pay attention to what central banks do, I pay attention to fundamentals. There is nothing more fundamental than the quantity and the cost of money. So short-term trades on currencies, we don't say, I think that the euro is going to 50 cents to the dollar. No, we don't take long-term bets. We think that short-term bets that we can monitor very, very much in detail, and that if we get it wrong, which sometimes we can adjust very quickly. No.
Okay, that's very interesting. And what sort of time frame do you mean by saying short-term, or specifically short-term, actually, not long-term approach?
Yeah, for us, short term, we're quite fundamental and quite long on. Some of our friends watching us from hedge funds may think that this is very long term. No, it's between 2 to 3 months. No, that's short term.
Okay, that's the short term.
That is a short term. Not today. Okay.
Yes.
So
yes,
but I think my experience in currency and in commodity trading is that the level of risk-adjusted bets that you can take on a 2 to 3 month range is probably less volatile and less, but more certain than what you can do on a 1 day, 2 day bet. No, I find it very difficult to. I find, kudos to those that can take huge bets the day before the Fed talks about, into a Fed meeting or into or into an ECB meeting. I give them my applause. I think that taking a bet with monetary aggregates, understanding those monetary aggregates, M1, M2, M3, and how they can play out for currencies, can give us risk-adjusted bets that do not generate significant losses if we get it wrong, which we may, and can generate decent creating a little bit of alpha on the top side or when we get it right.
Yeah. Thanks for sharing that, because as retail traders, we tend to try to be in and out as quick as possible, as soon as possible. For swing trading techniques, we usually keep trades for a couple of weeks' time, but that 2-3 month approach is not really how retail traders plays this game. And the next question, it comes to I realize in the 12 years of mainly trading experience I have so far, and by coaching and interacting with traders, experienced and beginners, there is a huge tendency to try and mimic the hedge fund approach, or someone who trades at the professional level without leverage, and try to create a way to trade, but deep inside is because they want to avoid losses.
Yes.
True. Yeah. So you just explain how the hedge fund mainly operates. Okay. And knowing how the retail trading, which you are well aware of that, absolutely. And people now, they start maybe thinking, so if I don't use hedge funds techniques to trade, how do I overcome and beat the hedge funds?
Okay. I would not recommend anyone to try to follow the strategies of multi-strategy hedge funds and large hedge funds for a very simple reason. It's like if I am with my little Vespa motorbike trying to replicate what somebody does with a Ferrari. It doesn't mean that the guy with the Ferrari is going to go to drive better, but it's simply that you don't have the tools, and you should not in general. Second, most hedge funds work with a very different strategy in terms of the return that they want to generate compared to retail traders, and obviously the amount of capital that some hedge funds may have in order to double down on a bet or something like that. Nothing compared with a retail trader. What I would suggest to all retail traders is to work more diligently with stop losses and take profits. It's impossible not to make losses, obviously. And the market is increasingly competitive, and there are great people, and there's great people everywhere. But think about it. So far this year, we have 7 stocks in the S&P 500 that are up 50%. 493 have done nothing. Okay, and the same with hedge funds. Hedge fund performance this year not particularly good. No, so if we think, what is a retail trader? A retail trader is someone that is supposed to avoid the traps of all the things that we probably do and have to do, the professional long-term investors, which is fundamental analysis, news flow, etc., and think only about what is going up, what is going down, why, and take advantage of very short periods of time. No, so from that perspective, what one has to be is 100% focused on what is going to be your stop losses and your take profit. And stop losses and take profits should be enforced, not should be. A lot of people have them, but don't follow them. And obviously, a retail trader has to have some capital to try to avoid. The biggest problem that a retail trader may have is that he or she can be right, but dead right.
Yes.
In the sense, in this margin calls kill you.
Yes. Yeah.
So you can have. I've seen very good friends that had phenomenal portfolios that were doing very well. A 2% increase in interest rates wipes out your entire performance. The point that I'm trying to make: don't replicate other people's strategies. You probably say this all the time. This is a process of learning, and we only learn with bumps, and we only learn with mistakes. And it's a process of building your own strategy that you're comfortable with, and it might be completely different to that of somebody else. And it doesn't mean that somebody else is doing it wrong. Is that precisely because the amount of money that we're using is different, the acceptance and tolerance for volatility and losses is different, etc. I think that it's basically just gradually, creating the tailoring the shirt and the jacket that is going to suit you, not me and not somebody else, but you.
Exactly. And that it's as you said, we say it all the time. I do it live, and still there are people they find it, they don't want to even try. Like in trading, we say, and I think you also agree, it's how much good we're going to be at protecting our capital.
Absolutely.
It's that skilled and art to protect my capital, and whatever I can extract from the market, it's going to take care of itself.
You're absolutely right.
Do you obviously, you said you agree with this approach, and do you encourage people to follow pretty much similar mindset and way of thinking in trading, instead of thinking, okay, I'm going to drag my stop loss further down if I'm long, in order hopefully that the market will bounce upward, or my take profit is about to get hit, let's say I'm long, and I want to drag it a little bit further to extract a little bit more, and then just one whipsaw, it's just take away the whole thing. Can you give your thoughts to the traders about that and investors?
Obviously, preservation of capital is the most important thing. You should not be thinking about the return on my money, but the return off my money. That's the most important thing. So we already suffer inflation, don't suffer deflation. Very important to be in capital preservation mode. That's one thing. The other thing that's important is not to chase beta, one way or another.
Yeah.
Chasing beta always leads to mistakes, because you get lazy or you get sloppy. So there's a phenomenal sentence that my ex-boss and great friend Ken Griffin used to say. It's just paper profits go to the bin.
Yeah.
Paper profits don't. If you want to learn about trading, you have to learn about trading, investing, not with Excel spreadsheets. I have never had. As you know, I'm a professor at two business schools. I've never had a student that did not have phenomenal returns in their Excel spreadsheets. Never. The best.
Okay.
Okay, so forget about Excel spreadsheets. Yeah? The paper profits go to the bin. So you need to learn by investing. Second, you need to think that when you don't forget about what is the upside of something. What is it that you set yourself to make with a trade? I was expecting to make 20% with this trade. At 20%, I get my money back. I buy myself a little something that will make me feel better, whatever it is, a book or a record, or I go for a drink, and I continue. And it continued to go up. Well, guess what? There is no profit made out of not selling and not buying. So be very diligent. Think about, this is the trade I'm going to make. Usually this trade, I have looked at it historically. For example, think about euro dollar. What are you expecting to make on the euro dollar? Do you really think you're going to make 50% on the euro dollar? No. Don't even think about it. No. What should you expect to make on the euro dollar? You should expect to make on the euro dollar as much as the tolerance of the president of the central bank will be for the currency to overprice or underprice relative to each other, because they're all working together. Okay. Don't think about stupidities about the Fed does this, but the ECB does that. They are completely in line. Okay. So do you think that Ms. Lagarde would like to see a 50% drop on the euro relative to the US dollar? No. Do you think that Mr. Powell would like to see a 50% revaluation of the US dollar relative to the euro? No. So then aim for 15%.
It doesn't help the trade.
Yeah, exactly. You see what I mean? A lot of times we are told that taking risk means pushing the limits, and it's not. Taking risk
without boundaries, huh?
Exactly. Taking risk is about understanding risk-adjusted bets. And I'll tell you one thing, and I'll tell you why. You're doing euro-dollar trade, and you're working with a 15% return, and you lose 5. Okay, it hurts, but it doesn't kill you. Imagine that you lose 15% in a portfolio. It doesn't kill your entire performance. If you're aiming for 50, the probability that one bad trade kills your entire P&L is almost between 70 to 80%.
Yep.
So the way that we have to look at a portfolio, in my opinion, is as if it was a living organism. There will be parts that are decaying, there are parts that are maturing, and there are parts that are growing. And you need to pay attention to each one of them so that none of them create a complete loss in your portfolio.
Yeah. So true. Yeah. Now, first, I would like to ask the audience, guys, please make sure you start entering your questions on the chat box. So we're going to leave a few minutes at the end to try and answer as many as possible. And Daniel, how do you believe the BRICS, that goes on lately, will affect the trading and investing world? Can we see maybe some currencies that potentially can lose their liquidity and volatility due to shift of flowings of money and all this stuff? So can you give us your thought about this?
Yeah, I think it's very difficult for the BRICS to put together currencies with completely different levels of capital freedom together. It's impossible. Furthermore, I think it's impossible as well for China to agree to join with Brazil, India, or Russia in a currency when the history of those currencies has been extremely weak relative to the US dollar. China may want to yuanize, as in make everyone use the yuan, but not absorb the monetary imbalances of Brazil or India. So what I think is that we are shifting to a world in which the fiat currency world is moving to become more dollarized in the Western world and more yuanized in the non-Western world. So we're probably going into move, there will be a number of currencies, but ultimately there's going to be two. Two large ones, which will certainly reduce dramatically volatility and obviously put a completely different perspective in how we look at fiat currencies. But obviously, in the process, there are a number of challenges, very big challenges, no? And my view basically is that we are living in a world in which what we are seeing is monetary debasement. Most central banks want to reduce the imbalances of the fiscal policy through monetary policy. And therefore, that means persistent, persistent inflation, weaker volatility in currencies, but also weakening trend of purchasing power of the currencies. You mentioned before, relative to gold in particular, and what that will create is very significant opportunities now in trading precious metals relative to fiat currencies. But I think that we are going to see a lot of currently existing fiat currencies that will ultimately be either fully dollarized or fully yuanized, if that word exists. I just created it.
Okay, that makes a lot of sense. You know what? I didn't hear you mentioning the commodity currencies like we know them as the Australian dollar, the New Zealand dollar, and the Canadian dollar.
Yeah. Well, I don't like to mention them as commodity currencies.
Sure.
Because as any of our friends that certainly trades the Norwegian krona knows that the Norwegian krona weakens despite oil prices going up. For example, no, and it's not the same with the Australian dollar. The Australian dollar has but I prefer to pay attention to what is going on with those currencies in terms of what is happening in terms of monetary tightening and monetary loosening. And if you think about it, the correlation with the underlying commodity is actually weakening in the past 5 to 7 years.
Yep.
Yet the correlation with the central bank tightening is very interesting. So that's something that we can look at in those currencies. Very interesting to trade. We like to trade the Australian dollar as a way of also mirroring, and people may find this interesting, mirroring when the Chinese economy is strengthening, the Australian dollar tends to strengthen as well. Obviously, higher exports, etc., etc. But the Australian dollar is a very good way of playing the Chinese rebound or a Chinese weakening, always paying attention to whatever the central bank is doing.
Absolutely. And, when you mentioned that, I remember I used to live in Australia, in Melbourne, for a decade or something, okay? Mm-hmm. And just a few months ago or 6 months ago, it was something I was reading on the news.com.au that the prices, the housing prices in the CBD of Melbourne, they rose this year by almost 30% due to Chinese people buying apartments in the CBD like crazy right now.
Yeah, absolutely. Those flows are always interesting to watch. We have seen it why did the Colombian peso strengthen so dramatically relative to the US dollar? Inflow of capital coming from Venezuela, from Chile, from other countries. All of those things matter more than sometimes we read in headlines or in studies. We talk a lot about supply and demand and all those things, but inflows of capital coming because of, there's a real estate contraction in China. So what are real estate investors going to look for in China? They're going to look for Australian opportunities. They're going to look for other opportunities. So all those things tend to matter.
Interesting. Now, another question based on what you said earlier with the commodities as we start the conversation. And it's interesting now with the BRICS, let's say, and moving, let's say, to few fiat currencies and paying more and put more weight, let's say, on these currencies in obviously strong economies. Can we still call the gold and maybe the crude oil as a safe haven commodities and assets? So to look for the very long-term bullishness on this one?
In terms of gold, yes. I think that gold is always, we may have the debate about the merits of gold forever, but there's something that we cannot debate. There's the fact that gold is perceived as valuable reserve of value, unit of measure, and method of payment all over the world. Doesn't matter. Mm-hmm. So gold is money, as JP Morgan apparently used to say, gold is money, everything else is credit. And commodities and oil is credit. And oil is not a good long-term bet. It is never a good long-term bet. I have heard for decades, you have that book over there, The Energy World is Flat.
Yes.
We always talk of oil in nominal prices. What we don't say is that oil today is at 1978 prices in real terms. So oil is not a good commodity from the perspective of expecting the price to always go up. We have seen that. There's also another book behind me, the myth of peak oil. No, I mean all these. In terms of those kinds of commodities, never believe in conspiracy theories. So, oil as a commodity is volatile, very dependent, more dependent on demand than on supply, and very dependent on monetary policy. So. If we start to see BRICS countries starting to trade more with their local currency, it may reduce some of the volatility of oil prices in nominal terms, but not in real terms. I.e., what am I trying to say? What I'm trying to say is that the problem of BRICS countries is not the dollar. The problem of BRICS countries is their own currency. It's not that the dollar is strengthening. The Federal Reserve's policy is perfectly adjustable and certainly accommodative. Whilst the problem of Brazil, the problem of India, the problem of Russia is not the dollar, is their own currency. And if they have, as some of them do, capital controls, it is impossible to have a world reserve currency with capital controls. As much as you may want to like the idea, no? Yeah. Like when you watch Star Wars, you want to like the idea that a spaceship can explode in space and that it can fall but they cannot fall and they don't explode. There's no oxygen. If there's no oxygen, i.e., if there are capital controls, you cannot have a world reserve currency. Think about all our traders that are watching us today. Imagine that they need to use some of their capital to trade, and you are told that you can't. Are you going to trade in that currency? No, you won't.
No.
That's why it's impossible. So I come back to the point. What the BRICS are saying first is a mirage. But what is more likely to happen is that many of those countries, especially the ones that have just joined the group or invited to join the group, like Argentina, etc., are likely to do a lot more trades in yuan. And that's fine with the view that I was mentioning you about polarizing the world. Mm-hmm.
That's very, very interesting, and that's awesome to hear. Now, I would like to ask you back to the fundamental side of trading. Let's call them fundamental. There are some news events that every retail trader and likely any investor, is paying attention to, like the GDP of a country, the consumer price index, of course, the interest rate, monetary policy, and trade balance, import, export, non-farm payrolls in the US. And from my personal experience, many years ago, it was a quite different. It was a bit more correlation with the outcome of the event to the near short-term future. But now it's like I see that only the interest rate, it's kind of a leading indicator, and the rest are lagging indicators. What's your view on that? Because traders, they say, okay, CPI, let's say if the European Central Bank will announce that CPI number for the previous month is down, so they expect it to jump on the euro and play it accordingly. Hopefully that it's going to lead the future. Can you help us understand what do you think about this?
You're absolutely right. I recently spoke with a good friend, a very seasoned investor, who said to me, fundamentals don't matter anymore, because when GDP print comes, the markets don't move if it's a good number. When CPI comes, markets don't move the way that they should, blah, 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 blah. And I said, well, it's not that fundamentals don't matter anymore. It's that the fundamental is the one that matters, which is money growth, money contraction. That is it. Okay. So you may have a CPI print that is better than consensus expected. The question you have to make yourself is, does it move the needle not for consensus, not for me, but for the central bank? Is the central bank really going to tighten on this piece of news, or is it just going to accept it as it is and continue with the path that they have announced? Mm-hmm. If, as the latest CPI print in the Eurozone proves, the latest CPI print showed that headline CPI was a little bit better, but core CPI was bad, or worsening. Okay, fair enough. Does that mean that the central bank is going to hike rates faster? No. Does it mean that they're going to cut rates? No. So don't buy the euro dollar. Okay. Obviously, I'm talking with hindsight. And this is why it's so important to have short-term and trade limits on the long side, and take profits and stop losses. Is that, hey, is it moving within or outside of the range? Is it outside of the range? Get out of it. Get out of it immediately. Don't even think about it. Okay? This is the most important thing. Don't think, oh, the market will react tomorrow because today, I don't know, was a World Cup day maybe, or I don't know, or Miley Cyrus had a concert. No. you get out of it because you got it wrong. Okay? If you expect a piece of news to move the needle on a price by 1%, and the price move is minus 0.1%, get the hell out of the trade.
My goodness, and especially if you're using leverage, yeah.
Exactly. That's that. But the point that I'm trying to make now is that macro figures do matter. They do matter in the long term and for many other things. But for short-term price moves, macro figures only matter if they are likely to change the view of traders of what the central bank is going to do. For example, you have a bad jobs figure, but it's still job creation, but it's still low unemployment, but it's still the employment to population ratio, which is the one that the Fed looks at quite a lot, is improving. Okay, so it's not going to move the needle on central bank policy. So it's likely not to generate a significant move in the market. And so try to think, instead of trying to think as what the piece of data should do to the market in its own, try to think what that piece of data is doing to the decision of the Federal Reserve or the European Central Bank or the Chinese Central Bank. What is it doing? Is it really something? Are they going to be looking at the screen like you, or are they going for lunch? They're probably going for lunch. So then don't do the trade.
Okay, that's very well explanatory. We have about 10, I will stretch it out actually to a little bit more, 10-15 minutes to give it. Guys, try to put, sorry, it's impossible to go through all these questions. There are numerous of questions. I'm going to be very piggy. Guys, try to do your best. Give me more questions. And I will ask you one more thing, and then we will go to the questions. Now, the last question, Daniel, comes from your book, Life in the Financial Markets. And you explain about the high-frequency trading, HFT, if I'm right. Can you explain us in a couple of minutes how or if the high-frequency trading affect a retail trader? They try to compete, they try to copy the technique, arbitrage maybe, and all this stuff. And so for one more time, maybe the retail traders, they keep calm and believe in themselves and their stop losses and all this stuff, and not trying to overcomplicate all the process.
Yeah. Never, ever try to replicate a high-frequency trader on your own, okay? It's like me trying to replicate artificial intelligence, or me trying to win the chess application that I play with. Okay, that makes no sense. Okay, I may win one time. Okay, but it's one out of all of the rest. High frequency traders are not good for retail traders for a very simple reason. High frequency traders are great for everybody because they generate liquidity in the market in periods in which probably, if it was only long-only investors, liquidity would dry up and markets would collapse. So one of the things that high-frequency traders do is reduce. I remember when I started trading that there were days of -3%, -4% in the market were actually quite regular. Now we are more than used to days in which we can spend a month without a -1% day in the market. Okay, that's what high frequency trading does. High frequency trading also makes it very difficult for people to find those intraday moves that used to generate 3-4% trades on one single stock, no getting in, getting out, just on a very quick note. So that's what they do. But we adapt to that the same way that we adapt to artificial intelligence. So don't try to replicate it. Don't try to copy it. More importantly, don't try to copy it for a very simple reason. High frequency trading is not one strategy, it's millions of strategies with completely different parameters. So, you're only bound to lose, no? So the best thing is to simply acknowledge the fact that intraday moves are going to be smoother, that monthly market moves are going to be smoother, that volatility is going to be lower, and that liquidity is going to be higher, which is a great thing for all of us.
Yep. Okay, thank you so much. So I wish we had more time. Really, it's conversations can be endless, of course. But let's jump to some questions. We have around 5-10 minutes max. So first question, this one here. How do you think CBDCs will affect trade markets in near future, along with cryptocurrency fractional markets coming into play?
Okay, it's a very, very good question. Central bank digital currencies are going to be very challenging for retail traders in currencies, in fiat currencies, because if a major central bank like the US or the European Central Bank is able to completely eliminate the transmission mechanism of monetary policy, and the entire money supply move is viewed and monitored by the central bank, certainly the moves that we are now accustomed to see are going to be much more challenging. And remember that the Fed, the ECB, until there was a big geopolitical conflict, which is very unlikely, the ECB, BOJ, Bank of England, and the Fed work alongside each other. So yes, that would generate a very significant reduction in volatility and in opportunities for short-term trading in currencies. However, the other aspect that he mentioned, or she mentioned, whoever it is very significant, which is the improvement in liquidity and the improvement in trading opportunities in cryptocurrencies. The big Achilles heel of cryptocurrencies today is liquidity. So fractional reserve, if we want to call it like that, but the ability to generate liquidity within its own universe of Bitcoin and other cryptocurrencies is likely to generate a lot more inflows and outflows, and therefore better opportunities. So actually, the world of fiat currencies that we used to live in the 90s is probably likely to become the opportunity in a fractional reserve environment, or fractional reserve, or fractional, how you want to call it, change in cryptocurrency. So that can be a very, very significant and profitable opportunity.
Thank you very much. Are stop losses necessary for a long, short, well-diversified portfolio?
Yes, because a long-short portfolio is never fully well-diversified. We in an environment of monetary expansion like the one that we live in, correlation between assets is very high, no? So they are important. They are important because stop losses do something to our brain and to our way of thinking, which is ultimately the worst thing that can happen to any of us, and it happened to me many times in a portfolio, is to have dead weights. They consume your brain. Your everyday thinking. Why the hell do I own this thing? Why on earth did I not sell this 4 months ago? Stop losses sort of take you out of the misery of saying if I would have or should have done. Okay, absolutely. There will be days in which you say, "God damn, I executed a stop loss just 3 days before it bounced." Yes, you know what? That will happen once, maybe twice in your entire lifetime.
Yeah, absolutely right. But then, as you said at the early beginning, is the battle, the inner battle. Should I mark around with that? Then retail traders, they have the tendency to, I would say most of them, okay, they have the tendency to think and believe that, hey, this trade, if it's going to work, it's going to buy me a new house, I'm going to buy a new car. This, I call it illusion.
Mm-hmm.
It's better unrealistic.
When you trade, you have to think, as you said before, capital preservation, number one. Number two, don't think this trade might buy me a house. Think, will this trade take away my house? That's the one that you have to think. No? And, and trading is always about trying to eliminate your emotions, and that's always challenging, obviously.
Yeah. And as time becomes more and more, now let's take the last question, guys. Okay, do you ever watch markets from a technical perspective? Question mark.
It's a very good question. Not as the only tool, but as one tool. In every investment meeting that I have with our team, there is always a technical analysis side, always, but it's not an overriding one. It's not an overriding one. I think that it's a tool that you can use, but like every tool, it should not be the only one, and it certainly does not have to be, and it's not the secret of eternal success.
Yeah. So it's like the one of the four wheels of a car.
Yeah. For example,
we still need it, but it's not the only tool.
Yeah, absolutely. For example, we've had a discussion today about precious metals, the weakness of silver, many things about this. And, we discuss the fundamentals, we discuss the monetary side, and we see, well, it doesn't look good from a technical perspective. It does look good from a technical perspective. So all those things come to fruition, and we decide and we monitor it on a weekly basis.
Okay, thank you very much. I think we are running out of time, guys. Sorry if I don't read aloud your question. It's just the time, it's very limited. We have another webinar starting after this. So any last comment, any last thought from you, Daniel, before we end the webinar?
Thank you so much. It's been an absolute pleasure. I really, really enjoyed it. Great questions, great conversation. And I think that everybody should think of trading as trying to be the least emotional possible and try to be as humble as possible. Markets make us see how bad ego decisions are every day. So we make we make mistakes every day, and we need to learn from them. So and the beautiful thing about markets, which I absolutely adore, is you have the most important tool, which is price, and price is everything.
Wow. I'll quote that one. So, Everyone said thank you to you. I'm sure you can read the
thank you so much.
Grateful, outstanding interview. So with that, Daniel, here at Admirals would like to really thank you so much for putting the time to join us on this exclusive interview. It was a pleasure and honor for myself to host this interview. I wish you best luck and looking forward maybe to another adventure in the future.
Absolutely. Thank you so much. It was an absolute pleasure. Thank you very much. Bye-bye.
Thank you, Daniel. Bye-bye. See you.